Hey, everybody, we're back tonight with Mark Collinsworth, a man that you know from the world of finance. And tonight we're going to talk about what happened with the markets on Friday and what's going to happen tomorrow when they open, considering the announcement of the new variant of COVID, Omicron, which seemed to tank the stocks on Friday. Now we're talking at this moment, it's Sunday night, October 28th, before the markets open tomorrow morning. So Mark Collinsworth, Vere Global Capital, you are the financial expert. First of all, what happened Friday and what's going to happen tomorrow when the markets open again? How big a factor will the new variant of the virus be?
Thank you, Larry. So on a Friday, which was a shortened trading day, it's very low volume. The market was only open for a half a day. But even during that half a day, the markets sold off the NASDAQ, the Dow, the S&P. They sold off roughly about 2.3% because this new variant, the Omicron or the B11.529 variant, popped up in South Africa. And people are saying that it's more contagious and more deadly than COVID or the other variants. And that kind of put a scare in the markets.
And they're saying that could affect everything from the supply chains to gasoline prices, et cetera, et cetera. So therefore, the big question is now, before it opens tomorrow morning, we're talking the night before, Sunday night, before they open tomorrow morning, what is your prediction? Is this going to be just a blip, or are we going to see this depression in the market for some time yet?
Well, I think the sell-off was kind of a blip. There was already some problems already developing in the market before the Omicron virus came out. There were some problems to the advanced decline line. More and more stocks were tending to go down. So I think the market was really looking for a reason to sell off, and it was probably sold off anyway. It was just a good excuse to sell it on the Omicron news on a half a trading day. So as for tomorrow, I think the market will probably rally up. You'll probably make back about half of probably what you lost on Friday.
How about in the weeks ahead?
In the weeks ahead, so right now, we're in the most bullish time of the year. So historically, November, December, and January are your three best months of the year to be in the stock market. Now, once we start moving into February and March and start moving into early summer, there's an old saying, sale may go away. That's when the unhappy time of the year starts. And we have several things looking for in late spring of next year. We'll start having the midterm elections to see, who controls the House and the Senate. And the Federal Reserve is going to start tapering. And depending on how quickly they taper and liquidity gets pulled out of the market, that might also have an impact.
But Mark, let's say, just suppose that this variant now panics everyone and we start seeing the effects of it, causing more contagion, more of the overloading of the health system, et cetera, won't that keep the markets down for quite some time?
I don't think so. Markets are really driven. People always say, the market moves because of this bad news or this happened or so and such. Really what moves the market is liquidity. Is there ample enough money flowing through the financial system to buy and sell stocks with? As long as that is occurring, stocks will move up. Or if liquidity is coming out of the markets will move down.
How about the other factors such as rising gas prices, increasing inflation, the price of everyday items, including food, continuing to go up? What effect is that going to have?
Believe it or not, none of those items have an effect until they start to affect the liquidity of the stock market.
Explain that, the liquidity of the stock market.
Liquidity, you can measure it in several ways. Some people use M2 money supply. People look at what the Fed's doing with quantitative easing. As long as the Federal Reserve is pumping money into the economy in some form or fashion, stocks have historically rallied on that. If you go back through history, every bear market in history has always started with the Federal Reserve taking liquidity away from the stock market by either raising interest rates or talking about raising interest rates or stopping a QE program and so forth.
So you don't think that's going to happen? They're going to keep interest rates where they are and the liquidity, it won't be a problem.
Well, Correct. Some people have been predicting that the Fed will start raising interest rates in the spring of next year. I think this Omicron variant thing will probably delay that until much later into the year. And then, of course, once you get to the midterms, the Federal Reserve really doesn't like to do anything with interest rates close to elections because they don't want to get blamed for tilting an election in a certain direction based on moving interest rates.
Right. So, interesting point here is that contrary to what many people may believe, the factors such as inflation, increasing food prices, gas prices, really doesn't affect the stock market because, stocks don't work in that realm. If you have a lot of stock, you'll be in good shape.
Correct. And it kind of gives you a really good example. If you remember last year when the stock market started falling apart, there really wasn't that many cases of COVID-19 actually in the United States at that time. And then, of course, the stock market was selling off hot and heavy. And then the Fed went in and started doing these massive QE programs. They cut interest rates to zero. They started doing interest rate swaps, just started pumping hundreds of billions of dollars into the bond market, into the banking system. And the stock market took off like a rocket. But when the stock market was taking off like a rocket, the number of COVID victims was starting to skyrocket at the same time. So if COVID really was the cause of the stock market sell-off last year, why was the stock market taking off like a rocket at the same time the number of people that were dying from COVID was also taking off like a rocket? So that kind of proves that liquidity really is the driving force of the stock market.
Now, some people question Biden's reappointments of Jerome Powell as the Fed chair. Wise choice or not?
Not really. The problem with the Federal Reserve is the Federal Reserve's kind of laid the groundwork for a possible inflation problem. And that possible inflation problem down the road will cause liquidity to come out of the stock market. And it's kind of the rule of thumb, the people that usually cause the problem aren't the best people to fix the problem.
So what do you see further down the road, factors that will indeed affect the stock market? Is there anything on the horizon that's going to drastically affect the stock market in the negative?
I think probably what you're going to have is the inflation problem will probably get worse before it gets better. And you'll probably see the Federal Reserve will probably try to take steps to pull that back and remove liquidity from the stock market. And I think that at some point in the next, 6 months to a year will cause a problem. And at that point, the Federal Reserve will turn the spigot back on and start pumping more money into the market, and the market will take off. Now, everyone says that's a great thing, but here's the problem. The Federal Reserve cannot pump unlimited amounts of money into the market indefinitely. Kind of give you some pointers here. If you look back when they started doing the stuff in 2008 with TARP and they started pumping money in, they thought that a lot of money on liquidity, they thought $800 billion was a lot of liquidity to pump into the market. Fast forward to present day, they are now having to pump close to $1 trillion into the market every year. They've already expanded the Fed balance sheet just here in the past year has already increased over $3 trillion. So I think that trend will probably continue, but at some point you just can't keep throwing $1 trillion, $2 trillion at a problem, because at some point it reaches critical mass to where even if you throw $5 trillion at it, it just won't fix it.
So now you're a financial advisor. You have many clients that depend on your judgment. They have stocks invested through you. So your advice is to stay in the market, not jump out of stocks and head for the hills?
I would stay in the stock market, and this is probably the best thing. If you're going to try to time the market, the old saying is, as Peter Lynch says, time in the market is more important than trying to time the market. If you try to break it down to one indicator that would tell you to be in the market or out of the market, look at the yield curve. Every bear market in history that's ever occurred, including last year's sell-off with COVID-19, have all occurred after the yield curve has inverted.
So
therefore, remain in stocks until the yield curve inverts. And what that basically means is when short-term interest rates are greater than long-term interest rates.
And when might that happen?
That will occur at some point after the Federal Reserve starts raising interest rates. When exactly it occurs, we don't know. We'll have to see the first Fed rate increase to really narrow it down to when it happens. But if you are curious, and this has been one of the big mysteries, is, last year, so when the yield curve inverts, every bear market in history has occurred between 6 and 12 months after the yield curve inverts. If you go back to September of 2019, the yield curve inverted in September of 2019, meaning just on that yield curve inversion, based on history, it means that somewhere between September of 2019 and September of 2020, you should have a big market sell-off or bear market inside that 12-month window. Now, we got that in March of last year. Did the big sell-off we get in March, was that because of the inverted yield curve that occurred a few months earlier, or was it really because of COVID-19?
What do you think?
I think it may have actually been more due to the yield curve. And this is the reason why. When the market started falling apart because of COVID-19, I went through and did research on every pandemic that we've had. I've looked at how the market reacted to the Spanish flu. Now, Spanish flu was really bad. You had tens of millions of people died from Spanish flu. It was 10 times worse than the people that died from COVID-19. I looked at the Hong Kong flu. I looked at H1N1. I looked at all these different outbreaks or pandemics that have occurred over the last 100 years. And in the worst case scenario, the stock market only sold off 12% in the worst case scenario. Why throughout the last 100 years, the worst case scenario was 12%, but yet this one in March of last year was almost 40%. Now, here's the interesting thing. An inverted yield curve tends to produce a 40% sell-off in the stock market more than anything else.
Yeah. So therefore, wrapping up now, Mark, your advice is to stick with the stock market, and nothing is going to change radically in terms of negativity for quite a while.
You'll get a few bumps in the road. I'm expecting to get a bump sometime next year just because the Fed will go into a tightening mode. But the bump, which I'm expecting to probably be maybe a 10 to 15% sell-off next year, I would look at that as a buying opportunity because, believe it or not, I'm extremely bullish on the stock market up until about 2028 to 2029, and then I would run for the hills.
Ah, okay. So we're at least 8-9 years out from that.
Yep.
Okay. So stick with the market until then. Mark Collinsworth of Vere Global Financial, thanks very much for your advice and your insight once again. Thanks.
Anytime.